Welcome to DF Markets Market Fundamentals. While many traders focus purely on price action, the movement of price on the charts, it is important to have an understanding of the underlying drivers that can affect price movement. At the heart of fundamental analysis is central bank policy and interest rates. The relationship between two currencies is essentially a function of the difference between their two respective central bank interest rates, as well as expectations of future central bank policy. The currency of a country with a high interest rate will typically be stronger than the currency of a country with a lower interest rate. Due to this dynamic, if a central bank raises interest rates, this typically causes the currency to rise, as a stronger interest rate attracts more investor inflow. Similarly, if a central bank lowers rates, this leads to a weaker currency, as investors prefer to move their cash elsewhere to receive better yield. Central bank rate-setting meetings are therefore of prime importance to traders, and a lot of time is spent trying to gauge whether the central bank will adjust policy at its next meeting, and how it will adjust policy, and as to the bank's future outlook. Each interest rate decision comes with an accompanying policy statement, where the bank will either sound upbeat about the economy and signal that rates are likely to be increased, known as being hawkish, which causes the currency to strengthen, or the bank will sound negative about the economy and signal that rates are likely to decrease, known as being dovish, which typically causes the currency to weaken. In terms of gauging the likely tone and policy decisions of central banks, traders do this by monitoring weekly data releases. Each week, different economic data points are released, ranging from inflation data and employment data through to manufacturing, GDP and productivity. Each of these data points gives an insight into the health of the economy. If an economic data for a country is improving, this is taken as a sign that the bank will be positive on the economy and seen as increasing the chances of a rate increase, leading to a higher currency as speculators buy the currency. Similarly, if economic data points are deteriorating, this is taken as a sign that the central bank will be disappointed with the economy, leading to a weaker currency and to speculators selling the currency.